In today's video, we're going to create a mini tutorial talking about how to invest in index funds for beginners. Investing in index funds is an excellent way to start building wealth. By making a small initial investment, you can begin to grow your money with minimal effort and risk. Index funds are an affordable, easy-to-manage way to diversify your portfolio, and they come with the potential for above-average returns. Whether you're just starting out or an experienced investor, index funds offer a simple solution for growing your savings. What is an index fund? Index funds are a type of mutual fund that tracks the performance of a specific stock market's index, such as the S&P 500 or NASDAQ. They are designed to provide investors with exposure to a broad range of stocks in a particular market segment without having to invest in individual stocks themselves. Index funds typically have lower fees than actively managed mutual funds since they don't require as much oversight from professional fund managers. Investing in index funds is an excellent option for beginners who want to start investing but don't want to spend too much time researching individual companies and their financials. Instead, they can choose an index fund that matches their investment goals and risk tolerance and leave the rest to the professionals managing the fund. Plus, since index funds are diversified across multiple companies, they tend to be less risky than investing in individual stocks. When selecting an index fund for investment, beginners should consider factors such as expense ratios, historical returns, diversification across sectors and industries, and overall track record. It's also important to consider any potential tax implications associated with investing in index funds if they are held outside of tax-advantaged accounts like IRAs or 401k. With careful consideration and attention paid to expenses and portfolio diversification, it is possible for novice investors to create balanced portfolios using these low-cost products. What are the benefits of index funds? One of the biggest benefits of investing in index funds is their low fees. Because they are passively managed, there are fewer expenses involved in running them as compared to actively managed funds. This not only makes them more affordable but also ensures that investors keep a larger share of their returns. Moreover, since index funds track broad market indices such as the S&P 500 or the NASDAQ, they offer instant diversification across multiple stocks and sectors. Another advantage of investing in index funds is their simplicity and ease of access. Unlike trying to pick individual stocks or analyzing financial statements, investing in an index fund requires little knowledge about the stock market. Additionally, since many companies now offer exchange-traded funds, ETFs, investors can easily buy and sell shares on major exchanges like the NYSE without having to worry about minimum investment amounts or redemption fees. Overall, for those looking for a straightforward way to invest money with minimal hassle and costs while still being able to achieve satisfactory returns over time, index funds can be an attractive option worth considering. How to select an index fund? When it comes to selecting an index fund, there are a few key factors to consider. The first step is determining your investment goals and risk tolerance. This will help you narrow down your options and select the appropriate index fund for your portfolio. Next, look at the expense ratio of the index fund. This is the annual fee charged by the fund company for managing your investment. Lower expense ratios are generally better as they minimize fees and maximize returns. It's also important to evaluate the diversification of the index fund. Ideally, you want a well-diversified portfolio that covers a broad range of sectors and industries to reduce overall risk. Finally, consider any additional features or benefits offered by the index fund such as tax efficiency or automatic rebalancing. By taking these factors into account, you can make an informed decision on which index fund best suits your needs as a beginner investor. What are the tax implications of investing in index funds? When it comes to investing in index funds, taxes are an important consideration that can impact your returns. One of the key advantages of investing in index funds is their tax efficiency compared to actively managed funds. The reason for this is that index funds have a low turnover rate, which means there are fewer capital gains generated from buying and selling securities within the fund. However, investors still need to be aware of potential tax implications when investing in index funds. For example, if you sell an index fund for a profit after holding it for less than 1 year, any gains will be considered short-term capital gains and taxed at your ordinary income tax rate. On the other hand, if you hold onto your investment for more than 1 year before selling it at a profit, you'll pay long-term capital gains taxes, which are typically lower than short-term rates. In addition to capital gains taxes, investors may also need to pay taxes on dividends earned from their investments in index funds. While some dividends may be qualified and taxed at a lower rate than ordinary income tax rates, others may be considered non-qualified dividends and taxed as ordinary income. As with any investment decision, it's important to consider the potential tax implications of investing in index funds before making any decisions about how to allocate your portfolio. How to rebalance your portfolio when you invest. One of the most important aspects of investing is ensuring that your portfolio remains in balance. Rebalancing your portfolio means adjusting your investments to maintain their original target allocation, which can help you avoid taking on too much risk or missing out on potential returns. To rebalance, you'll need to sell some of the assets that have increased in value and buy more of those that have decreased. There are several ways to decide how often and when to rebalance your portfolio. Some investors prefer a set schedule, such as quarterly or annually, while others opt for a more flexible approach based on market conditions. You should also consider whether you want to do it yourself or use a financial advisor. When it comes to index fund investing specifically, rebalancing may be less frequent than with individual stocks since they typically track an entire stock or bond market index. However, if you hold multiple index funds with different allocations, regular rebalancing may still be necessary. Remember that keeping your portfolio balanced is key to maintaining long-term investment success. In conclusion, investing in index funds can be a smart move for beginners who are looking to build their wealth through the stock market. By investing in an index fund, you're essentially buying a piece of the entire market, which can offer great diversification and minimize risk. Additionally, index funds typically come with low fees and expenses, making it a cost-effective way to invest. However, it's important to remember that investing always comes with some level of risk. While index funds may be less risky than individual stocks or actively managed funds, there is still potential for losses. It's essential to do your research and ensure you understand the fundamentals of investing before putting any money into the market. If you're looking for a simple way to start building wealth over time without having to worry too much about investment choices, then an index fund could be an excellent option for you. If you liked this video, please give us a thumbs up and subscribe to our channel to continue making informative videos just like this one. Thanks for watching.